Here's a detailed summary of Colgate-Palmolive's 2025 fourth quarter earnings call, designed for easy reading aloud. Good morning, and welcome to the Colgate-Palmolive 2025 fourth quarter and year-end earnings conference call. Opening remarks and financial highlights. John Fauché, Chief Investor Relations Officer, began by reminding attendees that the call would include forward-looking statements and that actual results could differ. Noel Wallace, Chairman, President, and CEO, expressed optimism about the company's stronger-than-expected Q4 results and its outlook for 2026, which marks the beginning of their new 2030 strategy. He highlighted that Colgate-Palmolive delivered organic sales, net sales, gross profit, base business earnings per share, and free cash flow growth in 2025, despite facing headwinds such as lower-than-expected category growth, higher raw material inflation, and increased tariffs. Wallace attributed this performance to the flexibility and resilience of their operating model. Encouragingly, the company is exiting 2025 with improved momentum, evidenced by organic sales growth in all four categories during the fourth quarter and sequential improvement in organic sales growth across most divisions compared to the third quarter. Modest volume growth was also achieved in Q4, excluding the impact of the Prime 100 acquisition and the planned exit of the private label business. CEO's vision and 2030 strategy. Noel Wallace elaborated on the company's new 2030 strategy, which he believes provides the building blocks for accelerated change, driving top-tier growth and total shareholder return. The 5 key focus areas are: 1. Strong brands with global reach, leveraging their competitive advantage, exemplified by the highly penetrated Colgate brand. 2. Accelerated investment in new innovation models, focusing resources on science-based innovation across price tiers and key growth markets. 3. Best-in-class omnichannel demand generation, adapting product delivery and messaging to connect with consumers at the right moments. 4. Doubling down on scale capabilities, investing in digital, data, analytics, and AI, including revenue growth management and AI-driven innovation, for faster growth and efficiency. 5. Optimize supply chain, utilizing predictive analytics and automation for customization, personalization, and optimal asset utilization. Wallace also emphasized the importance of culture as a competitive advantage and the ongoing development of a high-impact culture. The Strategic Growth and Productivity Program was highlighted as a key enabler for organizational changes and funding the new strategy. 2026 outlook and risk factors. Wallace expressed optimism for 2026, citing their new strategy, resilient operating model, and the continued outperformance of emerging markets. He noted improved momentum in Q4 in terms of organic sales growth and market share, along with a stabilization of category growth rates. However, significant uncertainty remains. Key risk factors include low category growth rates. While stabilized, growth rates remain low, potentially leading to increased promotional activity and competition. Foreign exchange volatility. FX has been a negative impact for 8 of the past 10 years, although currently favorable. Geopolitical environment. Volatility in geopolitics, including tariffs, particularly in Latin America. Sluggish U.S. market. While trends are expected to improve, a significant rebound is not being built into forecasts. Due to this uncertainty, Colgate-Palmolive is providing a wider range than usual for net sales and organic sales growth guidance for 2026 to incorporate various levels of category growth. Key financial metrics and management commentary. Organic sales growth. 2025 positive growth achieved despite headwinds. Organic sales growth. Q4 2025 sequential improvement in most divisions. Volume growth. Q4 2025 modest growth achieved, excluding certain impacts. 2026 organic sales growth guidance. A wide range of 1% to 4% is provided due to market uncertainty. 2026 category growth expected to stabilize between 1.5% and 2.5%. Foreign exchange, FX currently favorable, expected to provide a low single-digit benefit to revenue in 2026, primarily in the first half. This benefit is being used for business reinvestment and to contribute to the bottom line, offering flexibility within their business model. CEO and CFO statements. Noel Wallace, CEO. I believe our ability to deliver dollar-based earnings per share growth in a year with that much volatility is a sign that the flexibility and resilience we have built into our operating model is working effectively to drive value for our shareholders. We are exiting the year with improved momentum on our business in Q4 in terms of organic sales growth and market share, and we have seen stabilization of category growth rates as we exit 2025, but we still face significant uncertainty. Our new strategy and the resilience and strength of our operating model give us the ability to adapt to this volatile environment. I'm confident in our ability to navigate through this uncertain environment. I believe we have the correct long-term strategy, very well-designed 2026 plans, and, of course, the best people and culture so that we can continue to deliver value to all of our stakeholders through achieving our long-term ambitions. Stan Sutula, CFO. FX has only been favorable on an annual basis 2 of the last 10 years, and we know it can change quickly. As we look at 2026, we see it as a low single-digit benefit to revenue in 2026, focused on primarily the first half of the year. On the bottom line, we use that as part of our flexibility in our business model, using it to invest back into the business as well as contribute to the bottom line. If categories get worse, we're at the low end of that guidance range. If categories stay where they are, then we're in the middle of that 1% to 4% range. More than likely, if category strengthens, we hope to achieve more towards the higher end of that range. A robust balance sheet translates to operational efficiency, which offers sufficient flexibility. Notably, our debt structure looks favorable moving forward. With strong cash flow and low leverage, we have enough dry powder for our capital allocation. Segment and regional performance highlights. Hill's Pet Nutrition had an excellent quarter with strong growth in the U.S., exceeding 5% excluding private label, and positive volume. The prescription diet segment showed improved market share. North America, challenging but showed some improvement in Q4. Personal care remains a weaker point. Focus is on enhancing the innovation pipeline and revenue growth management. Emerging markets, broadly strong, with Latin America showing significant improvement in Q4. Mexico and Brazil experienced high single-digit growth. Asia also saw sequential improvement, with India returning to growth. China. The Colgate China team's success in omnichannel demand generation is being leveraged across other regions. Holly & Hazel is showing positive developments, especially in e-commerce. India. Organic sales were up, but underlying demand in the low-income urban consumer segment remains soft. The strategy is to focus on premiumization in urban markets. Canada. A nationalistic view is impacting results, but this is not currently seen spreading globally. Key lowlights/challenges. Sluggish category growth. Overall category growth rates remain lower than historical levels, creating a challenging operating environment. U.S. market performance. The U.S. market continues to be sluggish, with particular weakness in some core categories. Consumer uncertainty, impacting consumer spending and pantry stocking behavior. Future focus. Colgate-Palmolive is focused on executing its 2030 strategy, leveraging its strong brands, driving innovation, enhancing digital capabilities, and optimizing its supply chain. They are committed to investing in the business, returning value to shareholders, and assessing strategic M&A opportunities to enhance their portfolio, with a particular interest in Hills and other science-based pet nutrition businesses. The company is proceeding with caution, prioritizing reinvestment into the business, and is well positioned to navigate market uncertainties and optimize its portfolio.